Everyone, thanks for joining us today. We're going to go over the first quarter market review of 2023, what happened from January 1st to March 31st, as well as what's going on with the banking crisis, what's going to happen with the Federal Reserve, and as well as possible recession here. And then we're going to jump into investment implications for everyone on this video. And what does it mean for your stocks, your bonds, and your cash? First quarter is in the books. One of the down areas in the asset class was commodities. On commodities, you want to think of your raw materials like your copper, your oil, your gold. These were down about 5% on the quarter. On the uptick, U.S. REITs, they're up about 1.7% on the quarter. The multifamily and industrial areas of the REITs are still showing signs of resilience. We're starting to continue seeing a downslide in the commercial and office space. A lot of us are working remote now. And on a positive note as well, 60-40 portfolio. What I mean by that is your 60% equities, which are your stocks, and 40% bonds. These were positive for the quarter, about 5.6%, which is really nice. As well as our top asset class was our global equities. These are US-based companies around the world. You want to think of a company like Apple or Google, for example. And the numbers were good for the first quarter for growth. Indexes. We're going to hit a little bit about the Dow Jones index, the Dow Jones 30. It was up about 0.8 on the quarter. Not bad, still at a positive. These are some household names such as Home Depot, Walmart, Coca-Cola, Chevron, and Verizon. So the growth has been, a little resilient. Where we're starting to see a big area of growth was the NASDAQ. And NASDAQ started back in 1971, about 52 years ago. It is up over 17%. Now, it is a little tech heavy. These are your companies such as your Apple, Microsoft, your Amazon, your Google, and your Meta, just to name a few here. And on the different sectors, no surprise, financials were down over 5%. This is mainly because of the banking with Silicon Valley Bank and Signature Bank, and as well as energy and healthcare were negative as well. On a positive side were your consumer discretionary, consumer services, as well as your tech. Tech and communication services saw a 20% increase. Now, CPI, or your consumer price index, is still high at about 6.7. Last year, around the same time, is around 9. So we are starting to see a tick downwards. It's just taking a little bit longer. And banking sector did show signs of resilience. We did learn a lot from the crisis back in 07, 08. There's still some issues pending in Washington. It's going to be a painful process, but hopefully some changes are made, and it's going to make our system a lot more stronger. March 22nd, 2023, the Feds did raise a quarter point, and they're tightening their credit policies, so making interest rates higher. And it looks like they're going to do it again coming up in a couple of weeks to their meeting in May. So what this does is it makes lending harder for businesses as well as consumer spending as well. Big elephant in the room, Silicon Valley Bank. There was a crisis. It was the second largest collapse in history. And SVP was risky. They had nearly 50%, in risky deposits. 50% was in tech. They specialized in startups. It's right here, the peninsula in our backyard. And only a small portion of their assets were FDIC insured. And they did have a lot of their investment holdings in long-term assets. And when those assets were earning 0%, you get interest rates go up to 4%, their balance sheet was flip-flopped. And a lot of people were taking money out, rushing to the banks. We can click on our mobile phone to move money from bank A to bank B. And it's not indicative of a banking crisis, but there was some news that hit the headlines. It was bad. Some areas where we see some slowdown is manufacturing. And manufacturing has gone from expansion back in 2020, and it's now entering the contraction phase. So it's slowed down. And still on an uptick is your services. So they're still in expansion. And what I mean by services, it's not goods like manufacturing. Services is, flying in an airplane, buying airplane tickets, going to a concert up in Bottle Rock, game 5 of the Warriors and the Kings tonight. People are still buying, whether it's on cash or credit, and this is still contributing to 70% of the growth of the economy for GDP, or gross domestic product. And as I said, consumers are still spending, but there is signs of slowing down. We're starting to see less deposits go into savings, and we're starting to see debt accumulate. And also, less job openings means more competition and fewer jobs. So consumer spending is slowing down. We're going to see some more changes here in the future. And cash, we've seen cash increase, which is nice. We're also seeing our CDs and treasury bills increase as well, even corporate bonds. So we're seeing yields 4 to 5%, which is nice to see. We haven't seen this for a very long time, almost 16 years. Our big point too is to stay invested. So I want to give an example here of $10,000 invested into the S&P from 1992 to December 2022. If you had your money out just for the 10 best days over 30 years, your $10,000 investment would have went to almost $80,000, but you would have lost out on over 50%. If you had stayed the course, keep that 10,000, let it do its thing until December 2022, it would have went up about 17 times, or 170 plus thousand. Our point here is stay invested, stay disciplined. And to give an example on this as well, as we also want to stay diversified. We take REITs back in 2021, they were up over 41%. They're the top performing sector in 2021. We fast forward 2022, end of the year, REITs were the worst performing sector at negative 24%. So our job when we're building your investments is to keep it in a smooth ride. We don't want to be overweight on one sector, underweight on another, and we don't want to just buy you one stock and hope for a home run, because strikeouts happen. Our job is to hit you those singles and doubles, get you throughout the game. To sum it up, volatility is still here. It was here in the first quarter. We saw a big turnaround from 2022. Worst of inflation is behind us, but it's still going to take us a little bit longer to get out of the weeds. There's still interest rate hikes on the horizon here as well. And right now, though, a good note out of this, it pays to play defense. So the short-term treasuries, CDs, they're offering some attractive yields right now. There's still challenges ahead for investors. Our main point is stay invested and stay diversified. Thanks for watching.